and welcome to The Trade. Before we get to the technicals, a quick look at what traders are watching. And Federal Reserve policymaker John Williams, who is the candidate to become the next Fed chair, has advocated further easing this year, citing weakness in the labour market, going on to say that the risks of a further slowdown in the labour market is something he is very focused on, and that the tariff effects, in his view, have been a little smaller than expected. In Europe, the minutes from the ECB September meeting revealed that officials did consider another interest rate cut, going on to say that while a further rate cut in coming months would be better to protect the inflation target, the materialisation of upside risks would instead warrant maintaining the current level of the policy rate. US Treasury yields higher after an auction of long-dated bonds pointed to average demand amid the shutdown of the federal government that has blocked the release of official economic indicators, with the US two-year Treasury yield rising to 3.6% and the 10-year up to 4.15%. And the US dollar index has risen. It is at a two-month high, while the Aussie dollar has fallen to 65.6 US cents. Let's get more across the charts now. Zoran Kresovic from Blueberry Markets joins me. Zoran, great to see you. I mean, we have seen the Aussie dollar give back a little bit against the greenback, but you're watching the Aussie against the Kiwi, and this is quite remarkable given the RBNZ came through with a jumbo cut this week.
Thanks for having me, Julia. As always, pleasure speaking to you. That's right. Yeah. So we've seen Aussie climb quite heavily against New Zealand dollar. We've seen Reserve Bank of New Zealand actually somewhat surprising the market early in the week, or in particular on Tuesday, with a 50 basis point cut and bringing down the base rate to 2.5%. Obviously, that's kind of provided a knee-jerk reaction in terms of the Aussie versus the actual New Zealand dollar. And what we can see is actually not particular on this chart, but on Aussie New Zealand chart, that it's actually gone up approximately to a 3-year high. And right now, it's actually stagnating and providing a bit of resistance around that 1450. So we can see Aussie climbing quite aggressively, and that dovish stance from New Zealand or Reserve Bank of New Zealand is actually providing a bit of clarity and a bit of indecisiveness in terms of the economic conditions in New Zealand, which appear to be soft with the weak growth, muted demand, and inflationary pressures easing. So in the short interim, we are probably likely to see Aussie to continue head higher and break the major resistance level, which could provide quite significant upside against Aussie versus New Zealand, and especially with RBA's commentary this morning, indicating that we might actually, services inflation is slightly higher than initially anticipated in Australia, which could provide a hawkish stance on Aussie, and in fact actually would the November or February interest rate, decline or cut on hold, which could add more pressure on Aussie to continue heading higher.
All right, Zoran, let's get into commodities, because this positive news that the Palestinian militant group Hamas has agreed to a ceasefire in Gaza with Israel. What happens then with the oil market now?
Well, we've seen a knee-jerk reaction based on that geopolitical risk. If you have a look at the chart, Juliet, because crude oil has actually somewhat declined overnight, and in fact, actually, what it's done, it's lost a 4 days winning streak, and it's actually coming down to test the major support level once again around the $61. It's also, having a look at the RSI, it's not stating by any means that it's actually oversold, overbought. It's still within the mean reversion around the 50 points. But overall, it's providing a lengthy support level, which has been on the chart since about August 2025. We're also seeing a bit of an oversupply in the market from the US as well for the week ending on 2nd of October. We actually saw that there's around 2.8 million barrels in supply in the US as well. So linking the geopolitical risks with everything else that's going on across the globe, it's only natural to think that crude actually might decline slightly lower. I'd be looking at probably the major low, which was actually last Friday on 3rd of October, I should say, the low of $60.57. If we do break below that level, then we might actually head slightly lower towards that $58 to $60. But nevertheless, right now it's providing a good base, and hopefully can actually hold around these levels. Otherwise we would anticipate the crude is actually going to be a little bit more bearish than initially anticipated.
Yeah, exactly. All right. Well, gold, I mean, we know the $4,000 mark this week, the record, but it has pulled back similarly because of those same reasons that you discussed. So does that mean that we will see a continued pullback, or what are the technicals showing you?
Well, we've spoken on many occasions around that key level or key psychological level around 4,000, Julia. And now that we've actually broken through and in fact actually gone slightly above it, we can see that our RSI is indicating heavily overbought territory on gold. And the fact that it's actually retraced or somewhat reversed over the past 24 hours, on the geopolitical, de-risking or de-escalation of Middle East tensions, and also some profit taking as well. So it's only natural to think when gold anticipates or accelerates so heavily over the past few months in the ascending nice upward channel that there is some profit taking on the horizon as well. So look, at this point I wouldn't be too concerned. In my opinion, any dip is an opportunity to accumulate more. We've seen Goldman Sachs actually come out with their updated projections for 2026, indicating that gold should be anywhere from 4,200 to $4,600 an ounce, which is actually quite a juicy upside if you actually have a look at it, on the levels where it's at right now. We've also seen an enormous amount of ETFs or influx in gold from investors actually coming through in 2025. It's actually been up 17% year to date. So everyone is kind of trying to diversify their portfolios and hedge against any potential downside or global risk. And very lastly, we can see central banks accumulating record levels as well, especially in Europe. We've seen, for example, a country like Poland accumulating, going from 20% to 30% over the last couple of months in terms of the, accumulating gold reserves as well. So obviously something is brewing. It does appear that everyone is actually a little bit concerned right now. I don't know, what could happen in the near future, but what I can tell is that gold is a good hedge. It's good to have it in your portfolio, and it's good to actually buy any dips.
All right. Always good to have a little bit of gold. Zoran, thank you so much. Zoran Kresovic from Blueberry Markets. That does it for this edition of The Trade. Be sure to join us next time.